What's up, YouTube fam? Welcome back to the channel. In this episode, we're going to talk about how we've made $700 in the last 2 days and the 3-step option selling strategy that you will get paid for doing nothing. Right now, obviously, nothing is a strong word because you do something, right? You're putting risk on the table, but ultimately, does this require your time? Does it require your energy? Not really, right? And I know most people who watch these videos, most people who tune into my channel are people who want to learn how to create income with option selling because they don't have time to day trade. Maybe they just don't want to day trade. Maybe they realize that long-term investing mixed with a little something extra, right? A little way to create some sort of income is what they're looking for. Now, I'll tell you guys, as someone who's been a day trader, I don't really day trade as much. I don't want to say at all because I know some people will take it so literal, and then if I place a day trade, they'll get annoyed. Or sometimes you might take an option selling position and it goes up super fast and you want to get out right away. Listen, you can obviously day trade selling options as well. But for the purpose of this video, we're going to talk about how we've taken this account up 700 in the last day. And just so you guys can see, where were we? So this was January 28th. What's today? February 5th, right? So here you go. February 3rd, it was at 20.2. And here we are, February 5th, we're up 1,000. So listen, the beautiful part about this type of strategy is we don't really care about the, the intraday or the daily or the short-term gains rather, right? Because we know that with this long-term, it's going to pan out. And I do anticipate being able to get this account from 20 to the 30s, if not all the way up to 40,000 within a year. That's my goal, is to get this account up 100% within a year. So let's get into it. Let's talk about it. Let's talk about what we've done, how we've made this money, and how you can too, right? So when you pull up the TQQQ chart, right, what I love the most about the strategy we're running is that what's going on in the chart in the short term doesn't matter. Now, obviously, TQQQ is a volatile version of the NASDAQ, right? It has 3x leverage. And the problem with these 3x leverage positions, as you've noticed, is when they go into bear markets, right, they don't necessarily recover the same way as the NASDAQ. So if we pull up the NASDAQ chart, you'll notice how it went from, if we look at November 2021 to TQQQ, November 21, right, notice how it still hasn't even recovered all of its gains, right? And that's something that's very important to consider. And that's why this is an instrument really for selling options more than just buying and holding, is because we're looking to generate income on this more than we are looking to just buy and hold. Obviously, if you look at the NASDAQ, November 2021, let's see, right, you see where it was at 16,000, came back down, and now it's all the way at new highs. So ultimately, that's the only argument against these leveraged indexes or any of these leveraged stocks. And when you look at them, right, you see the same thing, like Coinbase, Connell. Notice how it made these highs in March, came back down, didn't break the highs again. But if you pull up the Coinbase chart itself, you'll see how the highs in March are now surpassed it. So what does that tell us? It tells us that long term, these 3x leveraged, 2x leverage, these leveraged stocks, you really shouldn't be trying to buy and hold. What you should be doing is looking for short-term purchases or playing some sort of option selling strategy on them to generate income. So with that being said, the 3-step play, ultimately step 1 is we're going to be selling puts, right? So obviously, as you guys see, when you look at the position, we're up $208 on this position. Now we've been in it since, I don't even know, Monday or Friday, since Friday, and it's had its ups and downs, right? It's been down for majority of it, but that's the cool part about when you sell puts or selling options in general. You'll realize you'll be down a lot of the time in the position of selling options, but as you get closer to expiration, theta just does its thing more and more and allows you to profit. So now at this moment, if I wanted to, I can just close this for 50% and open a new one, right? So if I wanted to do that, what I probably would do would be to open a new one with the 83, and in that case, I'd be able to make an extra $15 per contract, so an extra 30, or I could do the 83.5, which would allow me to make an extra $34 per contract, which would be an extra, what is that, $70 give or take. So right now I'm not going to do anything. Right now I'm just going to sit tight and let this play continue to make me money, because if I don't do anything and we assume it expires above 82.50 in 2 days, I will make another $214, right? So you can always get that number from looking at this or just doing this times by the amount of contracts. So that's where we're at in that position, right? So that's step 1. Is selling puts on something like TQQQ. Now, again, if your argument is against the leveraged stocks like TQQQ, CONL, MSTX, all of that, I understand, right? Because when you do look at the charts, you do notice that the bear markets do hit it harder, and ultimately something like NASDAQ, which has already completely surpassed its March highs by a long shot. You know, if you were holding TQQQ that entire time, you would barely even be scratching it, right? So right now, the NASDAQ is 32% above the March highs, where TQQQ, again, isn't even above it. Or sorry, not the March, November. I was referring to CONL, which was the March highs. But, you know, 30% ultimately over how long of a period, right? 3 or 4 years. You know, that's kind of the risk of selling options. That's kind of why we're selling options, right? Is because I'm not worried about the fact that, you know, if you were in, like I said, buying and holding NASDAQ, you would have made an extra 30%, because ideally, when it comes to what we're doing, we're going to make a lot more than that a lot quicker, right? We're hoping to make 5-10% a month, right? Even 20% per month. So when you're talking 30% over a 3-year period, you know, ideally we should outperform that tremendously. Now, of course, anything can happen in these markets, right? So we're not going to be ignorant. Now, that's the other thing I like about selling puts is, you know, for those of you who don't know what selling puts is, the basic way to explain it is that when you sell a put, you are getting the premium, and basically if it expires below your strike, then you were obligated, or not obligated, but you are basically supposed to buy at this price of $82.50, right? So let's just say by the end of the day Friday, this TQQQ was below $82.50. No matter what, I'm going to be collecting this, which is $2.14 times by 2. So no matter what, I'm going to be collecting $428. It's just a matter of, am I going to have to buy at $82.50 or not, right? Right now, it doesn't look like I'm going to have to. And the way to know where you're at is the delta. So you want to keep managing delta. Right now, obviously the delta is 32, which means there's about a 70% chance that it will expire out of the money. So with all that being said, what really makes selling puts interesting, and this is why I'm not afraid to do this on a leveraged stock like TQQ, is rolling. So what rolling is, in essence, it is closing your old position, opening a new one. But what makes rolling so interesting to me is, right, so when you look at the fact that we have the 82.50, right, let's just say hypothetically it did continue dumping. What you can do, right, is you can pick an expiration that's even further. So right now we have the 82.50 for $1.04. What we can do is we go 9 days out, and notice how we can go all the way to $78.50 and still collect a credit. So why is that important? It's important because we would end up collecting $16 profit on top of our current position, and hypothetically, if the market did start crashing, instead of having to buy at $82.50, we're buying at $78.50. So, you know, when you times that by, or sorry, so you understand, obviously, when you sell a cash secured put, it's 100 shares. So that means it would be $400 per contract. So, right, that means not only would we be collecting another $14, but we would actually be saving ourselves $800, because of the fact that instead of buying 200 shares at $82.50, we would be buying 200 shares at $78.50. And we can basically do that all the way down. So in the case of the fact that we did happen to buy the top, right, like obviously I don't believe this is the top, you know, I believe it will continue up. But in the case that it was the top and it did just go down, you can just keep rolling lower and lower. And hypothetically, in my opinion, you know, you do eventually want to get assigned. Now, to tell you when to get assigned, I can't tell you that. But hypothetically speaking, right, a perfect world is you roll all through this bottom and you get assigned somewhere here. And then obviously at that point, if you want to sell covered calls all the way back up, it would again require rolling the opposite, which we'll talk about in a second. But like in a perfect world, it's like, you know, you sell cash secured puts at the top. Like, put it this way, right? If you bought the top, obviously at that point your entry is 84. If it's all the way at $18, you are now down, you know, 70% on your money. But if you sold cash secured puts at the top, you can literally just continue rolling. And that's the beautiful part, right? Is the time horizon you can decide. If you had to roll for 6 months, 7 months, 8 months, 4 years, right? I mean, I'll tell you guys right now, I've been holding crypto for 4 years, 5 years. And when it comes to the market, it's funny, right? Because we're so focused on buying calls for earnings and 0 DTE and making 100% overnight, that we forget that like majority of your investments should have a 4 or 5, 10 year horizon, right? So even if it took 4 or 5 years, but the long play was that you ended up buying at $28 and then rode it all the way up to 200% to 84. And obviously, like I said, I don't think this is the top. I do think we keep going. That's really how you end up making the most. And like I said, what makes this so interesting is the fact that week by week, bit by bit, you could have rolled down and down, continued to collect credit, so you never actually lost a penny. Now, obviously, in the short term, your account might reflect losses, but the point is, in the long run, what ends up happening is the possibility to basically continue buying the dip, aka dollar cost average, without having to invest more money into the account. Now, this obviously only works on stocks that you can trust. TQQQ has proven itself that it will be here for the long haul, and I do trust it. I am willing to put my money up for it. Obviously, this isn't all of my money, and I've never advised anyone to do what I do with all of their money, but it is something I trust. It is something I'm willing to play for the long haul with. Now, when it comes to selling covered calls, again, it's the same thing. So hypothetically speaking, right, and this is a great example, we're in this covered call, and as you can tell, we're underwater. So we're down $222. Now, why am I not worried? All right, I'm not worried. First of all, why am I not worried about losing that money, and why am I not worried about losing this leap, right? And the leap, as you guys can see, is down 73. Now, this leap is 2 years out. Obviously, the break-even price is, where is it? $97. Do I think that TQQQ gets above 97 in 2 years? Absolutely. But even if it doesn't, as we covered, the covered calls would be able to, hypothetically, be able to erase all of the losses on the leap if we did go into a bear market. Right now, with that being said, being that the market is moving up and the covered calls are underwater, again, the cool side of it is I have the 8150 covered call, right? And as you guys can see, I have it for a $3.70 credit. Now, what makes rolling so interesting? So here's the thing: rolling doesn't really work for buying options, because when you buy options, it's the opposite. So if you want to roll, the strike that you want to roll into has to be cheaper. So you're basically, it really isn't even doing anything. You're really, again, just closing the position and opening a new one. But in this case, it's the opposite, right? And that the reason why it works in our favor is because the further you go out on options, the more expensive the premiums get. So in this case, all right, and this is something I probably will end up doing almost certainly, right? Because I'm going to have no choice, is to roll this position. Now, this is a big reason why when it comes to a leap, you want to do it with a smaller amount of your portfolio, because you really do want, what you really want is you really want the leap to win, right? We really don't necessarily care about the covered calls, right? We're doing the covered calls for extra income, but really what we want is this to win, right? We want this to go up. So when it comes to the covered call, what makes it, again, so interesting, and what makes this strategy, in my opinion, so much better than what meets the eye, is the fact that we're at 81.50 right now. For a $3.70 credit, we can get to 83 and collect a $20 credit. We can get to 83.50 and collect and lose $10. Or we could even go out of the money and lose, 40 for, right in the money, or 67 for at the money. Now, me, again, personally, I like to keep it at a credit, because when all is said and done, I like to not lose anything. And of course, the Nasdaq's never going to go straight up, right? It's never going to go straight up. As you guys see, the long term, it's always going up, right? And this is the TQQQ, but even the regular Nasdaq, it's even better. But there's always these days and weeks of red, right? And that's where the covered calls actually become more useful for us, is because you want that day or week of red, because think about it, right? If I roll, I'm still going to be in the money, which means I'm going to need another a week of red to get this out of the money and ultimately expire worthless. And the point is if it doesn't happen this week, right, we go for 16 days. So me personally, with this strategy, I'm going to be going a week at a time. Like, obviously in this case, if I wanted to get out of the money, I can go 16 days. So notice how when you buy time, the strikes get juicier and juicier, right? Because of the fact that you're trading time, right? You're trading time for money. It's kind of like the essence of life in general, right? You're either trading money for time or trading time for money. And ultimately, what my plan will be is to take it week by week. Now, the thing about rolling is you don't want to do it too soon. I've already learned the hard way, right? Like, obviously in this case, I'm pretty deep underwater, and it is tempting to just say, let me roll now. But we have Thursday and Friday left, and that is where the premiums, that's where theta really kicks in. So hypothetically speaking, all it takes is a bearish Thursday and a bearish Friday to send this covered call from underwater to back being profitable. Now, I will say this: I'm not in love with where I'm at in these positions, just because I don't like the fact that the cash secured put is 82.50 and the call is 81.50. Like, I'd rather it be in a world where I can expire worthless on both. So, I'm not in love with that aspect of these positions, but in the end of the day, they are their own positions. I'm treating them as their own positions, right? One has nothing to do with the other. Obviously, like I said, if I want, I can close this cash secured put for $200 profit immediately. But for now, I'm going to let it rock. Ideally, let it get to almost worthless and then maybe just roll it for the next week, right? Because that's the thing. This strategy is a strategy I want to keep playing. So again, the cheaper your current position is, the better you can roll, because, essentially, again, rolling is closing the current, opening the new one. So when you sell options, you want the options to become worthless. So in the end of the day, instead of closing this, right, hypothetically, if this option is worthless, I'll just roll for the next week and then be able to collect, a full credit again, as opposed to a difference, right? Because that's the thing. When you roll, you're just going to collect the difference, right? So in this case, let's just say I wanted to roll today to the 83, 9 days away, I would collect $278 instead of $500. Why? Because it would be the difference between these two. But if I wait for this to become worthless and then do it, it'll be the full 500. So, and obviously these are going to get cheaper every day as well, unless the market does go down. So everything does continue changing. Everything's ever changing. But with all that being said, that's the essence, right? Is like, this covered call, I really don't care about it at all, right? I just want to keep rolling it up until eventually it does expire worthless. That could take months, and I wouldn't care. And if it did take months, I'd be happy, because that would mean this continues going up. And then when I do eventually get to close this and expire worthless, it'll end up being a double win on top of the puts winning, which would make it a triple win. So right now, the only thing I'm green on is the cash secured put. But obviously this leap is 2 years out. So to even start thinking or worrying about it now is foolish. And this covered call, I can easily roll up. So again, I'm not stressing. But ultimately, as you guys see the result, according to Robinhood, we're up 170 on the day. But obviously, when you take a deeper look at where our account was, just 2 days ago at 20.2, we're up over $1,000 in the last, 35, 40 hours. And, again, the cool part is I'm not stressed or worried about anything that's going on in the short term. I got plenty of friends who are trading earnings. And obviously, like I said, I've been a part of it, right? I have friends who bought puts expiring this week on AMD, friends who bought calls expiring this week on AMD. The funny part is, right, and this is what we talk about on this channel, is, even though this looks like a huge move, if you bought puts expiring this week, the IV crush was so big that you're actually down money. And obviously, if you bought calls, I don't even need to say that you're down all of it, probably basically worthless. So, it's kind of just fun watching short-term traders scramble and lose their mind, while you do something like this with a long time horizon, and you're doing it on something like a QQQ where you're not really stressed at all, you're not really worried. There's really nothing about it that's making me lose sleep at night, where if I'm in 0 to 8 or high leverage positions, I do tend to lose sleep. So, if you're one of those people who, when you day trade or swing trade and you lose sleep, maybe you should consider this strategy, because I'll tell you one thing, when you sell options, you really do make some money and sleep like a baby. So I hope you guys enjoyed this video. I hope you learned a lot. The content, it's going to get a little repetitive in the sense of, like, this is a strategy I just plan to keep enacting. Obviously I'm going to keep freeing up capital. So as the capital continues to free, maybe I'll start playing with other things. I've been tempted to take this 1100 and take some maybe like riskier day trades, swing trades, whatever. But for now, I'm just going to chill with this play. I'm obviously still away. I talked about it in my Discord. So I haven't been as active. That's why I haven't been making as many videos. But I hope you guys got a lot out of this. Just got some insight into where my head's at, what I'm doing. I hope you continue to learn from me, whether it's from the plays that I'm winning or the plays that I'm losing. And I hope you take this knowledge with you on your option selling journey. So wherever you are, I hope you enjoyed this video. Make sure to like, make sure to comment your thoughts, make sure to subscribe to see where I take this account, right? If you're a hater, right, see if I prove you wrong. And if you're a supporter, see if I prove you right and get this up 100% in a year. But regardless, I hope you guys learned a lot, enjoyed this video, and I will see you all in the next one.